So Matt, so when these Amazon aggregators think of acquiring Amazon FBA business, then you are the one they actually call in making the due diligence process. Is that right?
That is correct. We get those calls. They say, hey, we're looking at this business. We have put in a preliminary offer, but now we want to figure out if we want to change that offer or even go ahead with the deal. We want to make sure that the business is what they're claiming. And that's when they call us. And that's when we go back through all of the information that seller has prepared for their financials to prove whether or not their sales are what they're claiming, their profits are what they're claiming, and all those various things in between, costs of goods sold, ad spend, platform fees, are accurately presented. And that really makes the buyer's decision whether or not to move forward, whether or not to revise their offer, or whether or not to back out of the deal. So we are right in the middle of that whole process between buyers interested and seller actually gets a check.
Excellent. So you're pretty much daily involved in these kind of like acquisition processes, these mergers and acquisitions.
Absolutely. I mean, we've done over 100 deals already this year to date. And even with activity slowing down a little bit, we're right at the forefront of seeing what the trends are, what prices people are paying, what's affecting their decisions, what kind of businesses they're looking for, and how that process keeps evolving over time as more aggregators come into the market. Some are leaving, and a lot of them are changing their criteria as the market continues to evolve.
Thanks. And so could you actually, Matt, briefly give some introduction about you? What is it that you do?
Sure. So I'm the owner and founder of CapForge. We do bookkeeping and tax accounting for small businesses, predominantly e-commerce businesses. E-commerce sellers make up over 80% of our clients, over 1,000 clients that we have that are in this space. So it's something we do every single day, all day long. We work with sellers who are selling on Amazon and the various marketplaces, or Shopify, Walmart, etc., US-based and overseas-based sellers. And this is what we do for them. We make sure that every month their financials are accurate. They reflect what the activity is that they've sold, their costs, and their profits. And we can help with cash flow projections and advisory services and income tax filing and sales tax and all those things that relate to the accounting aspect of this kind of business. And it started out with just one client in this space 8 years ago. And that client was happy and said, hey, I'm in a Facebook group. Can I mention to some other folks in the group that you've done this for me? And I was really happy. And I said, yes, of course. And one thing led to another. And, here we are today, one of the, if not the biggest, one of the very biggest accounting firms specializing in e-commerce, and certainly the biggest one specializing even within the e-commerce space on the mergers and acquisitions due diligence process.
Yeah, that's the typical way, right? I mean, get one happy customer and then it just leads to another one, and like the snowball takes off.
Exactly.
Cool. So you've been doing this pretty much for like 8 years or so. So what do you think, how have you seen this space evolve?
Well, I mean, if you kind of look back to where things started then, in the old days, Amazon, there was lots of categories where you would find, less than 10 sellers in a particular sort of product category. You could get by just by having a well-written listing with keywords that, other people hadn't optimized for, and then making sure your photos were good and your description was robust and all those things. You could literally make sales just by having a well-positioned product placement in the Amazon catalog. And of course now, without ad spend, it's really difficult, and there's competition for days, right? And just even sort of random small specialized categories, you might have 100 different sellers with products that are competing for that space. So the landscape's really changed. You could make a lot of mistakes back in the day and still be okay, still be successful and grow your business. Now, you really have to be on top of it. You have to make sure that all your numbers are accurate and that you can see that your products are performing, because otherwise the competition will kind of eat you alive. And with ad costs coming in and shipping and logistics costs going up and product costs going up, but still the competition to keep prices low, to drive traffic, it's become a much more competitive landscape. And the people who take it seriously and use their data to make good data-driven decisions can still be successful. The people who are, sort of seat of their pants and just, taking guesses, they're really having a hard time being successful. Whereas even 3 or 4 years ago, they might have done okay. Now it's just really a whole different landscape.
Yeah, and that definitely means that you just need to become better at it. So you actually need to put in more effort and treat it more like a real business, and really come up with this unique differentiator factor, and really developing your X factor. So I have always told my students that the market doesn't need any more garbage. So right. we don't want to even launch exactly the same things that the market already has. So we don't want to be better only at marketing, but actually developing the product as well, and basically just constant improvement after another.
Absolutely. I tell our clients, think of it as a real business, because it is a real business, right? You should give your customers a reason to pick your product, right? They're going to be presented with a range of choices. Give them a reason to pick your product over some of their other choices, and build on that brand. Establish yourself as a real business that people will in the future search for, not just the product type, not just spatula or garlic press, but they'll search for your brand, because your brand solves a problem in a way that other brands or other similar product types don't. And you build an ecosystem, you build a brand, you build a business that's repeatable and sustainable, and not just dependent on gaming the Amazon system or outspending the competition to get to the top of the listings, or putting out another whatever product that it's not different and not any better than any of the other 500 choices they could have bought. So focus on building a real business. Amazon and any of the other e-commerce platforms are just that. They're just platforms. Sometimes people say, oh, I run an Amazon business. Well, not really, right? Amazon runs an Amazon business. You're just buying products from China and trying to sell them for a few dollars more than you bought them for, right? That's not really a business. What you want to do is think about a brand, a line of products that complement each other, a reason for customers to come to you and purchase, and they just happen to be buying from Amazon or from Walmart.com to get your product. But that's just putting stuff on Amazon isn't really a business.
Exactly. And so what would you say? You have seen so many deals in this Amazon space. You have personally worked with and being involved with all these different deals. So what would you say, what's been the common nominator between all these brands that are being acquired? Sure, you could only look at it's at a numbers game, but besides the numbers, what are those other common nominators?
Well, it's really changed, right? So 12 months ago, 18 months ago, aggregators, big aggregators, Perch and Thrasio and some of those guys, they really were just looking at the numbers. Okay, you have $1 million in revenue and $250,000 in SDE. And so we'll pay you 3x for that or 3.5x for that. And we don't care if you're selling, baby bottles or kitchen gadgets or outdoor exercise equipment. We don't care. We're not even looking at what your product is. We're just looking at the numbers. And their whole game was they would buy these businesses at 3x or 4x, a multiple of the profits, right? And they would aggregate them all together, which is where the name comes from, into one big company that ran all these different product lines that had no relation to each other and may or may not have been any good. And they would have now $1 million of revenue in theory and $250 million or $25 million in profit. And they could sell that to a buyer for 8x or 10x or 12x, or even go public and sell, or value the company on a multiple of revenue, not even profit. So that was their game. They didn't care what your product was or the strength of your brand or anything else. What happened was they ended up buying a lot of businesses that just weren't that good. They were just random products on Amazon, no particular reason for people to buy them, and sales fell off, margins got smaller, and the whole sort of theory of putting this together fell apart. Which, you could kind of see the handwriting on the wall. You could see this was going to happen. Why they didn't figure it out. They were just hoping to get in and get out quick. But now what they're looking at is what we just said, right? They want to buy businesses. They want to buy brands that have sustainability, that have a path forward to grow, more products to add. They want to try and capture that customer information and resell the customer's future products and cross-sell. Now you're seeing aggregators who are concentrating in specific areas. This aggregator only buys supplement companies. This aggregator only buys, toy companies or whatever. So they're being more strategic and thinking ahead about what they're buying, and they're not buying those sort of vanilla plain companies that they were buying 18 months ago with a different plan. So that's the biggest thing I've seen that's changed, is aggregators and buyers in general. There's other buyers in the ecosystem besides aggregators, but they've gotten smarter and pickier, and they've decided they're only going to buy businesses that have a sustainable business model that can stand on their own 2 feet and not just rely on, more cash to kind of prop them up and a short-term horizon that they have to survive through before they get passed on to the next foolish buyer.
Mm-hmm. So let's say that once these aggregators actually hire you to do the due diligence, so can you actually walk us through the process? So what exactly happens during that process? Like, first of all, like, what are they hiring you to do, and what are the specific things that you actually look for, and so on?
Right. So, what they've been presented, the basis of them making an offer to this particular seller is the seller has told them, I sell, $1 million a year. These are my costs, and this is my profit. So the aggregator, the buyer, takes that at face value and says, okay, if you really make that much in profit, we're willing to pay you 3 times that number and acquire your business. But they haven't really investigated whether those numbers are accurate or put together correctly or follow proper accounting principles, right? They're sort of taking it on faith at that first stage. That's when they call us and they say, okay, CapForge, can you go through all of the actual documentation and information and either verify that the numbers we were provided are correct, or let us know what the accurate numbers are? So what we do is then get a hold of all the bank information, all of the platform reports, any payroll information, invoices from, purchases of inventory, all the documentation. And we basically rebuild our own set of financials. And then we hold them up next to what they were presented as originally and see how well they stack up. Most of the time, right, the revenue is fairly accurate, because especially if you only sell, say, on Amazon, it's fairly easy to pull the Amazon reports and say, I really did sell this much. Even that, though, sometimes can be problematic, because, for example, if you sell on Shopify, but it's fulfilled by Amazon, sometimes we've seen customers or clients where they'll count the Amazon revenue once and then they'll count it again from Shopify, even though it was really the same revenue, right? So we go through and verify, this is the actual correct total sales. This is the actual correct platform fees. This is the actual correct cost of goods sold that it took to get those sales to happen. This is the correct ad spend. And then these are all the other costs, insurance and payroll and contractors and everything else. And then we see how it stacks up. And sometimes it's fairly close, right? The original seller may have said $1 million in revenue and 250,000 in profit. And we find 1.05 million in revenue and $240,000 in profit. And the aggregator says, okay, that's close enough. We'll stand by our offer. But sometimes we'll find, okay, your $1 million in revenue is right, but you really miscalculated your cost of goods sold. You underestimated your ad spend. You attempted to not include things that should have been included, and your true profit was only 125,000. And then at that point, the aggregator says either we're not interested, it's now too small of a deal, we don't want it, or we'd be still willing to buy it, but our offer has gone down substantially based on the actual performance of this business. So that's why it's so critical, if you're thinking about selling your business, to work with us or somebody like us first, get the accurate numbers first, present those to the aggregator, and then when they go through and do their due diligence, there's no change. You're not surprised to find out the number I thought I was going to get for my business is really only half or a third of what I thought I was going to get, because the accounting I did just wasn't up to the standards of what it should have been.
Yeah, and when you actually started discussing with an aggregator, I mean, it starts from numbers, right? I mean, those are pretty much the first thing you present. And if you actually present something that's inaccurate or just plain false, then I mean, that can actually become a really big problem. And you basically can, there can be like a loss of trust. And so it can pretty much like break the whole deal.
Absolutely. I mean, it's a question of credibility, and you only get one or two chances to say something that turns out not to be true before, after that, everything after that you say, they don't believe and they don't want to do business with you, right? It's like online dating. If you say you're 6 feet tall, right, and then you go to meet the girl and she finds out you're only 5'4", she might also not believe that you're a millionaire or that you're even, right? She's like, wait a minute, you already lied about
what else is wrong here?
What else is wrong here, right? So better to make sure you measure yourself first correctly, and then present, the facts that you can stand behind and that will survive that due diligence process. Otherwise, you're going to be, they're still going to find out, right? Any buyer who's going to spend 6 or 7 or 8 figures on a deal is going to do their homework. And if you've been doing it wrong, whether you intentionally or unintentionally, I mean, a lot of times accounting is wrong and the sellers just don't realize it because they're not accountants. They were trusting whoever they had doing it that was doing it right. They didn't know it wasn't. But you're going to present that, they're going to do their homework, they're going to find out what the real results are, and then the offer is either going to change in a direction you don't like or evaporate altogether.
Yes, and there's actually quite many things that you can mess up when doing the books from Amazon, because I mean, there's so many different things there that you can miscategorize or just put in the wrong place. So I mean, that can just completely screw up your numbers.
We see it all the time. I mean, I would say, somewhere between 92% and 98% of all the bookkeeping we see has some degree of errors. Now, whether it's a fatal error of a large amount or a small error that can be fixed and isn't necessarily going to completely destroy a deal, but still the errors exist. And the problem is e-commerce accounting is really its own specialty, right? There's a lot of different things about it that are completely unique to the e-commerce world. So if you go to an accountant or a bookkeeper who, they worked on a restaurant before or the doctor's office or something, and then you hand them your e-commerce business with Amazon and Shopify and Walmart and cost of goods sold and tracking inventory and all these other things they've never done before, I mean, the chances of them getting it right are pretty small. So, you may look at their numbers and say, well, I can't tell that it's wrong or right. It seems like it's okay. But, believe me, when it comes to me, and we do our homework on it, we do our due diligence, if there's problems, we're going to find them. And it's rare that we find them in the favor of the seller. We go, whoa, you told us you had $250,000 in profit, but really it was 400,000. Congratulations. That doesn't happen that often.
Yes, and one key thing that will really have big impact on these deals are actually those Adbacks. And I mean, those things can get pretty complicated and subjective. Okay, is it included or will it not be included? So that's definitely what's your take on that? Adbacks in general?
Right. So, I mean, one of the things we really try to help our clients do that we're doing the accounting for is understand what the add backs are, what's reasonable to take and what's not reasonable. And to the extent possible, really, it's good to minimize them, right? Because the fewer there are, the fewer there are to have a debate over. Sometimes clients come to us, or we do due diligence on deals where within one set of books, they've not only commingled two or more businesses that they only want to sell one brand, but there's two or three brands all in one company in one set of books. So now we have to sort of separate that out. But then they've also commingled personal expenses or unrelated other. Oh, I've started investing in crypto. Okay, right. We have to take all that stuff off. So the ideal situation, if you know you're planning to sell, is one, make sure you only have one business per entity, one set of books that 100% of everything in this books is going to be sold. We're not commingling it with anything else. We've also taken out personal expenses and also anything that's maybe a shared resource. We have a lot of clients that own two or three brands, but they have one graphic designer VA that they use across all three. There's ways to deal with that. But if you come to us kind of at the last minute and say, oh, I'm already, in the process of selling and I have all these expenses that are mixed, now we have to kind of figure out how to sort that out. So the fewer add backs you can have in general, the more beneficial it is to this process. There's just fewer mistakes that could be made in deciding what does and doesn't count. But generally speaking, for people who maybe aren't aware, or just for clarification on this discussion, an add back is something that didn't contribute anything to the results that the business got. So obviously ad spend was critical, right? If you hadn't spent those ad dollars, you wouldn't have had those sales and you wouldn't have had that profit. But, if you went out to dinner and you wrote that off for the business, or you run your personal automobile expenses through the business, or you go to travel and you say, well, I could be researching new products, but really it was just a fun vacation. You run that through the business. Those kinds of things, whether a new owner did those or not, wouldn't have impacted the results the business would get. So those are considered add backs. And then you can kind of get into more complicated decisions, like if you spend $10,000 to have your website redesigned, that was a one-time cost. A new owner wouldn't have to spend that $10,000 again. But the argument is, well, did that $10,000 investment help the sales, and so it shouldn't be an add back, or it was a one-time expense that won't recur, so it should be an add back. So we go through with clients and try to help them maximize the amount of add backs they can claim without getting themselves in trouble where the aggregator or the buyer is going to say, wait a minute, you can't add that back. That was a real business expense. That should be included. And now again, you're sort of reconfiguring what the valuation is.
So what's your take on like one-time expenses, like expenses on market ranking and like giveaways and those kind of things? Are you actually able to find a way that it would not be included?
Well, yeah. So, I mean, sometimes those one-time launch expenses are for a product that that doesn't actually perform very well, or doesn't even continue to be sold. So if you have a discontinued product, let's say normally the valuation is based on the last 12 months, right? So if you have a launch cost from 6 months ago and that product takes off and does really well, those launch costs help you get that product to perform well. And now you're receiving profits from selling that product. That's not an add back. On the other hand, if you launched a product, you spent $25,000 for giveaways and rebates and promos and extra ad spend, and you launched a product that's only sort of break even, and then you decide to discontinue selling it, and a new buyer wouldn't even be selling that product, then all of that can be an add back because it didn't affect the profitability and the success of the business that the new owner will be taking over. So it's sort of case by case. We try to always, if we're working with the client as the seller, right, we try to be as positive as we can in finding add backs because that helps the value and they get more money when they sell. On the flip side, although we use the same standards when we're doing due diligence, if we feel like they've been overly aggressive in adding back expenses that really weren't critical to the business success, we'll bring that out too, and at least have it be a point of discussion. Hey, we think you should ask about these expenses. They've they're saying they're Adbacks, but we feel like without these expenditures of money, the business wouldn't have the valuation that they're claiming.
Yeah, makes perfect sense. So when you are hired to do this due diligence, so what is basically the specific like outcomes or like the deliverables that you give to the aggregator?
So it's basically two things. The primary deliverable is the brand new set of financials. So they can see month by month, going back 2 to 3 years, how this business has actually been performing with every single number. So if they point to a number, how did you get this for ad spend? How did you get that for cost of goods sold? How did you show that for revenue? We give them the supporting documents. Here's how we got that number, right? Because the seller, a lot of times, especially if they've done their bookkeeping in Excel, or, you know, they had somebody do it who didn't really understand e-commerce, they'll say, well, you know, here's what we're saying we got for cost of goods sold in July of 2021. And we said, well, how did you get that? And they go, I'm not really sure, right? So what the aggregator wants from us is, if they point to a number, say, how did you get that? We go, here's all of our work papers, right? Here's everything that we use to come up with this number, all the supporting documentation. So they can feel confident that the numbers we're giving them are what they really are. And then they can look at that and decide, okay, we're happy with the offer we made, or we want to reprice the offer. We still like the business, but it's not as good as we thought. We want to reprice our offer, or it's really not as good as we thought, and we're going to cancel the deal. We're not even going to make the offer anymore. So one deliverable is that set of financials with the supporting documentation that tells the aggregator or buyer, this is what really happened with this business over the last period of time, that you can have confidence in making a decision to buy or not buy. The other thing we give them is just the benefit of our experience, right? We say, look, we have 1,000 e-commerce clients. We're looking at this client and saying, you know, they are outperforming of, you know, let's say they're in the supplement space, and we have about 55 other clients in the supplement space. You can say they're in the top 10% of sales, but they're also maintaining high margins with low ad spend. This is a good example within the supplement space of a profitable and, you know, successful brand. Or on the flip side, you know, we got 55 companies in the supplement space. These guys, although their sales are good, their ad spend is double the average that we see. Their cost of goods sold is triple the average that we see. And they don't seem to, you know, have a lot of room for optimization here. So we think even though they're doing as good a job as they can, they're in the bottom 25% of supplement companies for their size. And that makes the investment riskier because there's not upside to grow there for whatever reason, systemically, or whatever their product mix is, or brand, or whatever. They're just not doing very well. So we can give them the factual numbers, and then we can also sort of help benchmark against our experience with other similar clients to say, this brand looks really strong. This brand is sort of in the middle of the pack, or this brand is a bottom tier performer.
So do you actually mean that you're not only looking at this business and the numbers and everything, what's happening with that business, but you're actually taking a look at the market like as a whole, and what's actually happening on Amazon, in the marketplace, and so on?
Absolutely, yeah. I mean, they hire us fundamentally to help them decide, is this a good investment? So part one of that is to say, are the numbers we're using to evaluate this even accurate, right? So step one is, let's get accurate numbers and see if those match, or if they're up or down. But then part two is, okay, great. Now we know how it did historically, but how good of an investment do we think it's going to be into the future, right? Which is another key piece. Sometimes a business could have done very well. For example, right, a lot of hobby related businesses did very well from 2020 through 2021 because people were stuck home and it was a different time in the world. But how are they going to do from 2022 forward when people aren't stuck at home and things have changed and supply chain issues have come up and inflation is hitting? Are people still going to be as excited about maybe this crafts product or something? So we want to look at that too, not just, yes, what they reported historically is accurate, but where is it going, and what are its chances of success into the future? Obviously, we don't have a crystal ball, but we can at least kind of look at some of the other factors, outside competition, growth rates, margin maintenance, and see how we think the trends are pointing and whether or not it looks like a good investment for the future.
So how do you actually do that forecast process? Like what are specifically the things that you're looking for? So are you looking at some like based on the categories and what's actually happening on Amazon, or I mean basically also outside of Amazon?
Well, I mean, we don't, we're not spending a ton of time trying to forecast, macroeconomic trends, or, spend a deep dive into the hobby industry to, what's the prediction for the hobby industry through 2025. But we're looking, to the extent of the information we have and can see readily, and, just in general, right? Is the business continuing to grow, or have sales leveled off, or sales declining? And at the same time, have margins held steady? Are they declining? Are they improving, right? As you continue to get bigger and bigger as an e-commerce business, you should have more pricing power as a buyer. So your cost of goods sold hopefully should stay the same or even improve, right? Because before you were ordering 1,000 units at a time, and now you can order 5,000 or 10,000. So are you able to take advantage of that pricing power? Are you building a brand so that your ad cost is coming down, or at least staying steady over time, right? If you have to keep spending more and more on ads to drive traffic to get sales, that probably means your brand doesn't have any real value, right? Because you're still just competing with people who are looking for sewing kit versus somebody who's looking for, magical unicorn sewing kit, your brand, right? And you're not potentially taking advantage of, okay, people have bought my product. Am I doing anything after that first sale to try and resell them, to get them on a mailing list, to offer them a free book of, craft templates, so I get their email so I can alert them to future projects or products? If you're just grinding through selling products, no plan, no brand value, then chances are you're not going to be as good of investment versus a similar company, similar metrics, but who's taken the time to build a brand, built repeat sales, worked on their COGS, worked on their ad spend, and proven to be a more valuable business. Even if today they both have equivalent metrics, one is clearly just selling products with no thought, and the other one is building a business.
So have you actually ever had a case like when you're doing this process that it's pretty much like one-to-one, meaning that the original reports, like what the seller provided, that okay, this is pretty much like good to go. There's nothing to kind of like point out or anything like this?
I would say that's rare. I would say, 10% or fewer of the deals have no material difference between what was presented and what we found when we did it ourselves. I would say 50% of the deals have a variance of plus or minus 10%, which is not huge, but at the same time is not nothing, right? If you were going to get paid $1 million for this, and we find a 10% difference, so instead of $1 million SDE, now it's only 900,000, and you were getting a 4x multiple, right? That's $400,000 less that you're not going to get paid because your numbers were off by that amount. So $400,000 is, a pretty substantial amount to not be getting paid when you thought you were going to get paid that.
Yeah, it's a decent amount.
It's, everybody's perspective is different, right? For some people, that's a lifetime of wealth, and for other people, that's a slow February. So, right,
or a wild weekend,
right.
Weekend at Vegas.
So, everyone's perspective is different, but I think for the vast majority of people, right, giving up $400,000 you weren't planning to not get is, kind of a shock, right? It's not something you'd happily give away by accident. So I would say 50% of the deals are in that plus or minus 10% range. And then the other 40% are even bigger than that, 10 to 25% variance from what was originally reported. And usually in those cases, it's where either the seller was doing their own accounting, or they hired a VA, or somebody who wasn't e-com experienced, wasn't even particularly accounting experienced. Maybe they were trying to save money, They found somebody on Upwork or Fiverr or whatever, but the numbers were substantially incorrect. And so when they get recast and done correctly, they're surprised to find that the business not nearly as profitable, not nearly as valuable as they thought. And most of the time, I would say those deals fall apart completely. The offer is rescinded because the aggregator is just, the deal value they expected is just too far off of what the actual was.
Yeah. So what kind of things would you say, or you have seen that, okay, what would be actually be a deal breaker? Like, have you had cases like where you actually find things and then deal is off? And is it only based on that the valuation just goes lower and the aggregator is not interested, or is it actually something else, something that you find?
I would say most of the time it's about the value and the numbers, right? Most of the time that is the deal breaker. However, we just had a deal where the financials were all fine, but it turned out that the seller, although they had registered a brand, hadn't really done it properly. There was a conflict. Another brand claimed that, they shouldn't have been able to register it. And there was a big legal battle pending, right? So if you say the whole value, or part of the biggest value of my business is I have this great name, this great brand, people search for my name, it's really helping drive the business, and then you come to find out that now if you don't stop using that name, you're going to have a big legal fight and you'll probably lose. Well, of course, the buyer is going to say, well, I want no part of that, right? I don't want to buy a brand where if the name goes away, what did I buy? And if I try and keep the name, I'm now going to be sued and have these huge legal bills and probably lose anyway. So most of the time, it's about the value and the financials, but not always. There can be other things that you didn't take care of properly, or that can be a problem that will kill a deal. Sometimes too, if you complicate a deal too much, even if the business probably was okay, the aggregator doesn't want the headache. Like if you've built your own manufacturing plant, right? You literally make your own product from raw materials and you assemble it and then you sell it. A lot of buyers don't want to take on that piece, right? Because now not only do I have to figure out how to sell it and be profitable selling it, but I've got to be a manufacturer too. And a lot of them just aren't
completely new
interested in
business
that.
model.
Right. I have to, I just wanted to place orders and get the stuff and send it to a 3PL or send it to Amazon. I don't want to be a manufacturer. Now I've got to have staff and equipment and machinery and a physical location that I have to worry about. And, so there's nothing wrong with the business. It's as profitable as they claim. It's a solid business, but it's just not what that buyer or that group of buyers is looking to get involved with.
Yeah, makes perfect sense. So what can you say about the deals that you work on? Like what's like typically the size of these deals?
I would say right now, the smallest deals that the aggregators are looking at is generally, you have to have at least 300. I would say that's the bottom floor for SDE. And really most of them are looking for at least 500,000 and they prefer $1 million and up. The small deals, even though you're getting a much smaller amount of revenue and profit, take just as long to evaluate and assess and decide and integrate into your other group. So they've just kind of moved away from sort of any deal as long as the margins are okay to, we really want to get something that makes it worth our time to invest. And the bigger, generally the better, right? It's easier to do one deal to buy a business that makes 50 million in revenue and 10 million in profit than do 10 deals that do 5 million in revenue each, right? Because it's about the same amount of time to do either deal, but one of them you have to do 10 more or 9 more times to get to the same size. So they've really kind of gone up in size. And the other thing is they're really spending more time trying to figure out if this brand, this business has its own value or can grow into a valuable business, rather than, again, just somebody who's sort of, I'll sell whatever product, I can make money on. Those days, those businesses are kind of gone by the wayside. Or a business with, they've got 100 SKUs, right? But only 2 of them make money, right? 2 of them are 80% of the revenue. So it's sort of, well, why am I buying the other 98 SKUs? It's just headache and
Exactly.
stocking and investment in inventory that's going to move slowly at small margins. So they're really looking for people who are smart business owners. Those guys or gals are getting the highest valuations and the most interest. And that's like business 101, right? In any environment, whether it's, high times or recessionary times or good times or bad times or whatever, the good, solid, profitable businesses with real brands and real business models, there will always be buyers for those. The businesses that could kind of skate by and just make some money hustling, but didn't have a real plan and a real brand, in good times, those guys can do well too, and may even find some buyers. But when times get a little tougher, like now, those are the first ones for people to say, I'm not interested, or, if I buy it at all, it's going to be at a low price, because they just don't have the same sustainability as a good, solid business.
By the way, do you remember what was the multiple for the first Amazon deal that you were involved in? So that was some 8 years ago.
Yeah, I mean, back then, businesses were selling for about the same, about 3x was, I would say, the sort of average price then. When things got the most sort of frothy and excited, and everybody was sort of competing for deals back in, mid 2020 into early 2021, I would say it went closer to 4.5 as an average. And we were seeing people who were getting 6, 7, 8 on deals that today they would be happy to get 3 or lucky to get 3. So, obviously competition drives prices up. When you have one potential buyer, you're kind of stuck with whatever the offer is. When you've got 8 potential buyers all vying to get your business, of course you can play the sort of one off the other and drive that price up. But I would say those days are largely gone. There's fewer offers, the buyers are smarter, the offers are lower, and we're back to sort of that 3x average until you get to, a certain size, at least say 1.5 to 2 million in SDE, and then you're, 4.5 and up from there. The bigger you get, the higher the multiple.
So what's your view that where is it heading up, like this year, next year, and so on?
I think a lot of people who run marginal businesses, meaning not that great, haven't put a lot of thought into their brand, haven't gotten past $10,000 or $20,000 a month in sales, those folks are going to have a real hard time, right? But the people who put thought into their business, have an intention, are building a brand, are building stuff outside of just the e-commerce, just outside of Amazon. They're building a brand, a reason for people to come and find their business and shop with them and repeat buy. Those folks are still going to do well. But, the easy money days of Amazon from 7 or 8 years ago left. And even now, the not too bad days of 3 or 4 years ago have gotten harder. And now you have to run it like a business. You have to know your numbers. You have to make data-driven decisions, and you can still do really well. There's still literally hundreds of millions of shoppers on Amazon and Walmart and looking online that you can sell products to and that are happy to buy products and pay a fair price. But it's not easy pickings anymore. You have to be intentional with your efforts.
Yeah, and now we come back to what we basically started with, that you really need to build this brand, and I mean you really need to build a premium brand, because if you really have a premium brand, then you can actually get this premium valuation. Mm-hmm. Because I mean nobody's competing with you. You're basically different in all levels, so that can have huge impact on the valuation of your business.
Absolutely. And the buyers are recognizing that, and they're rewarding that, right? If you have a truly unique business that occupies its own space in the market, and customers who are looking for that and will find you by name and not by, the similar generic kind of products that with no name, no brand, whatever, they will pay more and seek you out. If you can position your business in that way for whatever category you're in, you will be able to command not only probably multiple offers, but a higher price than a more generic Me Too kind of business seller is going to get, if they can find a buyer at all.
Yes, and there was actually an interesting question from Mani Kanta, and it's actually better for you since you're Americans. That what's your take on the potential U.S. recession and how that will actually impact the business?
I think that, you know, it's a mix, right? So we have high inflation, which a lot of the rest of the world has as well. I was just reading, in fact, that the US inflation is right in the middle of the global inflation. Our inflation right now is about 8.9%. Turkey was the worst. They had 74% inflation. And then there's countries that are doing better with inflation. So that's affecting people's, you know, spending power, because things cost more, groceries and gas and everything else. So they have a little bit less discretionary income. But on the flip side, our unemployment rate is very low. Almost anybody that wants a job now can find a job, and wages are going up, more or less matching inflation or close to. So people are getting bigger paychecks to help offset the cost of things that are going up. And when I go out just on a personal level, restaurants are still full. People are going to movie theaters. People are out and about on the weekends. People are still planning summer vacations, driving and flying. So I think, yes, there was a big pullback in the stock market, and cryptos, you know, falling through the floor. From those indications, you say, oh, the economy looks, you know, not great. It looks like a recession. But from what I see, people are still out and spending money and, you know, not really being held back. Yes, they may be a little more cautious. They may not quite buy as many, you know, impulse items and things like that, but they're absolutely still spending money. They're still feeling relatively good about things overall. And, you know, I think it's not going to be a real downturn in the e-commerce shopping world. People are still going to buy. And the thing with news is, right, especially American news, or at least the news that I see, it's always extremes, right? This side hates the other side, and this side is so angry. But really, most people are I'm just living my life, working, doing things. You know, I don't all that noise.
Yeah, you don't
on the
notice
news.
that drama.
You don't feel it. You don't see it, and everybody else is just, you know, it's the 1% on one side, 1% on the other side that are making all the noise and yelling and talking. The 98% in the middle are just, we're just trying to do our thing, live our lives, be happy, you know, whatever. So it can be distorting to think that, you know, 50% of one side and 50% of the other side, they're at war with each other. Really, that's not how it really is on the street.
Yeah, it's funny. Like 2 years ago, I remember in the news in California, there was like news that okay, there's a huge earthquake coming up, and it was all over the news. And then it's coming during the weekend. But anyway, I mean, we pretty much like forgot about it, and then we realized, hey, was there supposed to be earthquake in the weekend? Oh yeah, like what happened to that? Yeah, there was an earthquake, but I mean, it was just a tiny one. And
right.
So,
I mean, the news has to, they want viewers, right? They want attention. So they make stories seem like a big deal. They seem like, you know, something everyone should pay attention to and everyone should be concerned about. But most people go, forget it.
Yeah. There's a question from Tuomo that what's the youngest brand where you had done due diligence?
We've had a few businesses that have sold just after their 1-year birthday. So literally brand would, you know, launch in June, and by the following July, 13 months later, they were selling and they sold successfully. But I would say that is definitely the rare exception, because 12 months is really hard to know. Was this just a short-term fad? Or is this a real long-term successful business? So I would say for the most part, you'd want to have your business be at least 2 years old and really better 3+. So unless it's a phenomenal, exceptional business that, you know, and a lot of times what happens is that's a business that was started by somebody who's already bought or started and sold 3 other ones, right? So they know how to start, they know how to hit the ground running, they know how to do it successfully, and they can in a year's time really build something pretty impressive. right? But for the average person just starting first business, you're going to make mistakes. You're going to not have a lot of capital to invest. You know, you're going to have a hard time in just 1 year being able to build something that somebody's going to want to buy in that short of a horizon.
Yeah, and it's pretty crazy. Like past year, I mean, I've seen like deals that have been like less than 1 year, like even just like more closer to 6 months. So it's crazy times, definitely. And like some aggregators don't really even care about that. Okay, if you're like younger than 1 year now, like no big deal. If they really like want to buy it and really see like interesting thing happening on.
Yeah, I mean, it's certainly possible that you can have, you know, maybe you have some unique product, or you're, you know, you've custom built it or created it, or you've got a great brand name and you know, social media and TikTok and whatever, and it's huge and there's a lot of interest, even though it's only 6 months old, they can see the potential is there and they'll buy it. But that's the exception. I wouldn't plan for
Yeah,
that
yeah,
for sure.
definitely. It's not the average.
Yeah.
Yeah. So Thomas was also asking like how long is the due diligence process?
Typically for us, it takes between 2 and 4 weeks. It depends really how quickly we get all the information from the seller that we need to put everything together. Some sellers, the day one of the project, here is everything. We can provide all that you've asked for. Other sellers can take, 2 or 3 weeks just to get us over what we need to get started. So it's really more dependent on that side than our side. For us, it's typically about 2 weeks, sometimes 3, depending on the size of the business, to do everything we need to do.
Yes, and one thing we didn't really go deep on is that, yes, I mean, you also offer your services to sellers, meaning
Right, that's really
you and I discussed about one of our brands that you would actually do those books and basically get everything ready uh, for the aggregators.
right. That's really the biggest piece of our business. The due diligence is sort of a side piece that's small. We do a lot of it, but in reality, that's a small piece of our business. The by and large, largest piece of our business is working with sellers every month, preparing those financials, getting everything correct. So one, they can manage their business from accurate numbers, but then two, if they do decide to sell, they can go into the due diligence knowing nothing's going to change because it was prepared by a firm that already knows what the due diligence process is going to be. And, you'll go into it with the number and you're going to come out the other side with the exact same number. So no surprises.
Yeah, and like we discussed before, like you can only make like one impression. So
Right.
numbers are what actually give you credibility. So we want that the numbers we give are actually really like accurate and there will not be any surprises.
Absolutely.
By the way, one quick thing that you also mentioned about like outside of what's happening also outside of Amazon, but like I've talked to so many aggregators and most of them pretty much only care what's happening on Amazon. So they are not really like that much interested in, I mean, they will of course consider the numbers, what's happening like on your own website and so on, but like they pretty much are focused only on Amazon and nothing outside of that. But what about the deals that you have been doing? So like, are you like, are like the aggregators looking for specifically what's happening outside as well?
Yeah, there are some aggregators that specifically only want deals that are own brands that sell on Shopify direct to consumer. They don't, if you've got Amazon, they're not interested. And there's other aggregators and buyers that like you to have multi-channel, right? The risk of being 100% on Amazon is if for some reason your account gets a suspension or some other problem happens, your revenue goes immediately to zero. Whereas if you're also selling on Shopify and Walmart, you have some protection. And on some of those platforms, you can do more to capture your customers. Whereas Amazon obviously doesn't really encourage you to know who your customers are and be able to sell to them again. They want everything to go through their platform. So some aggregators are looking for predominantly or exclusively Amazon or Amazon FBA exclusive deals. Others are looking for a mix. And there are even some that, if you sell exclusively on Shopify or on your own website, they want to talk to you and they don't particularly want to deal with Amazon and its restrictions and fees and everything else. So there's a buyer out there for any situation. It just depends, you know, what you've got. I wouldn't plan to build your business around what the buyers want. I would plan to build your business in a way that's best for your business, whatever that may be. And then when you're ready to sell, you find the buyers who fit with what you've built.
Yeah, and then it really comes down to like, okay, what are you specifically doing with your brand, and what's actually the best case for the brand in question? Because I mean, it's because every business is different, and okay, what's the potential of the brand and so on. So that definitely makes a big impact. But hey, so Matt, I know you need to run to another meeting, so we have a couple of questions. Maybe we can just quickly run through those. So
sure.
Well, there are like specific questions about numbers and fees and that kind of stuff, but I mean, it always depends on the like size of the business, right? Like,
right, exactly. Every quote we do is custom to the specific business. If you've got a very small business, you're just on Amazon, just one bank account, you know, that's going to be very small. It may even be under the minimum we have some pricing on our website. It may be even under the minimum. On the other hand, if you've got a larger business, more platforms, more products, more accounts, you know, that's going to be more. But I'd encourage anybody, you know, if you have questions, I'm happy to answer them. Send us an email. Go to capforge.com. From there, you'll find our contact info. Send me an email. I'm happy to respond to individual questions, you know, and that way I know we're kind of out of time, but anybody who has individual questions about our services or just in general about selling or anything else we talked about today or didn't even cover today, I'm happy to provide, you know, free individual responses, no problem.
Cool. And what would you say, like, is it easier to get everything right from the start, like in terms of books, or like get it like after a year, like just do it once?
Well,
after a year?
The farther you go without doing it right, the more potential there is to have a bigger cleanup project. What I generally tell people is once you start having revenue coming in, it's a good time to start thinking about it. And if you get to that $20,000 a month plus revenue value, that's really when you should have proper bookkeeping. Before that, save the money, invest in marketing and more products, and make sure the business is going to be sustainable. But once you get to about $20,000 or more in revenue per month, really that's the time to make sure that the numbers are getting recorded accurately, because you're going to want to make some decisions around those results. And without proper accounting, you're really guessing. You're kind of in the dark on exactly how well you're doing.
Tuomi is also asking like how many aggregators there are.
There's probably about 100 aggregators that are self-identified as aggregators. There's easily double that number that are out there that you wouldn't be able to find them in a Google search, but you know, they're nevertheless out buying multiple businesses and building a similar kind of model. And then beyond that, there's literally thousands of individual buyers and small group buyers. So there's a lot of activity out there. There's a lot of capital looking for good businesses to buy. But if you're just saying just sort of aggregators that you could do Google search and find them on a list of aggregators somewhere, there's around 100 currently actively out there now.
Yes, and I mean, there are just so many like kind of like private people buying businesses as well. So it's kind of difficult to give an exact number.
Yes.
So, hey, Matt, thanks so much for joining us and giving valuable information. I mean, it's a pleasure talking with you.
Thank you for having me. It's always fun for me to be able to share some of what we've learned and answer questions and help people out. And again, if anyone has more questions or whatever, you know, feel free to get in touch, send us an email. I'm happy to respond from there. Yeah.
So could you actually share your email on the chat?
Yeah, sure. So the website is capforge.com. And then my email is Matt, M-A-T-T at CapForge, CapForge.com.
All right, cool. I wrote it there. So thanks, Matt, so much. And,
all right. Thanks, everybody. Thanks for having me, Tony. I appreciate it, and look forward to chatting again.